how exactly do you bounce back from a massive $77 million crater in your financials and then turn a clean, healthy profit in just one single year? Well, welcome to the Edgar Brief. Today, we're cracking open the Q3 2026 10Q filing from Simulations Plus. That's ticker symbol SLP, filed on July 9th, 2026. We're going to translate this dense SEC document into plain English. Now, quick note before we jump in. We are independent, not SEC affiliated, and definitely not financial advisors. We use AI to summarize, so errors can happen. Always verify on sec.gov before making any money decisions. Okay, let's get into it.
Here is the hook. Last year, this company posted a brutal $77 million loss for the quarter. Just an ugly number. But fast forward 12 months to this current filing, and they are solidly back in the black. So to figure out how they pulled off this wild swing, we first need to understand exactly what they do.
All right, Section 1, the business model.
The best way to think about Simulations Plus is to imagine a highly sophisticated flight simulator. But instead of training pilots to fly airplanes, it trains pharmaceutical companies to develop drugs. They operate in a space called biosimulation. And in plain English, that just means using software to virtually test how a brand new drug will interact with the human body. Before a pharma company drops billions of dollars and years of time testing a drug on actual people and potentially failing or, crashing, they use this software to predict the outcomes. It saves time, it saves a ton of money, and most importantly, it saves lives. So how does the cash actually walk through the door? It basically comes in through two main doors. About 58% of their revenue comes from software licenses. This is their core product installed on client servers or in the cloud, generating those nice recurring fees. The remaining 42% comes from consulting services. This is where they essentially rent out their own scientists and engineers to help pharma clients run these complex virtual trials and navigate all that regulatory red tape. So basically, they're a software and specialized consulting hybrid, making money by speeding up drug approvals.
Moving right along to Section 2, the financial scorecard.
Let's look at the raw numbers. Are more dollars actually walking in the door? Well, total revenue hit nearly $22 million for the quarter. That's up 7% year over year. But what's really fascinating here is where that growth actually came from. The software side? Flat. Totally flat. All of that top-line growth was driven entirely by a 20% jump on the consulting services side. Turns out, their human experts are in incredibly high demand right now.
And here is the answer to that mystery from the very beginning of the explainer. Net income swung from a staggering $67.3 million loss last year to a $3.6 million profit this year. How? Well, because last year's massive loss was driven by a one-time $77 million impairment. Now, impairment is just accounting speak for management raising their hand and admitting, hey, an asset we bought or built is actually worth way less than we originally thought, so they have to write down its value on paper. It was an ugly accounting charge for sure, but absent that ghost of the past, the core business today is actually highly profitable.
You can really see that core profitability shining through in their gross margin, which is sitting at an impressive 69%. That means for every dollar that walks in the door, 69 cents sticks around to cover payroll, R&D, and rent. And that's actually up from 64% last year. Management notes this is thanks to higher billable utilization, meaning their consultants are spending way more time actively working on paying client projects and way less time just sitting on the bench. Now, we say this a lot. Accounting profit can sometimes be a fiction, but cash is absolutely real. Over the first 9 months of the fiscal year, they generated a very real $19.4 million in operating cash flow. Add that to the fact that they've got over $50 million in total liquidity between cash and short-term investments, and you get a super clear picture. I would totally label this an impairment recovery turnaround. The accounting bloodbath is in the rearview mirror, and the cash register is ringing. Okay, on to Section 3, the moat check.
A great quarter is nice, but we really need to know if this business is durable. Like, why can't a deep-pocketed tech giant or some scrappy startup just steal their lunch tomorrow? Well, the answer lies in intense switching costs and a highly specialized scientific engine. Once a pharma company builds its multi-year drug development pipeline inside this specific software, ripping it out and starting all over with a competitor, it is incredibly painful, insanely expensive, and just way too risky.
But honestly, the real moat is right here. They are deeply embedded with institutional and regulatory heavyweights, most notably the FDA. Think about it. When a regulatory agency uses and trusts your biosimulation software to evaluate new drugs, your product effectively becomes the sticky gold standard for the entire industry. If the FDA is using the flight simulator, you better believe the pharma companies want to train on that exact same simulator.
Let's dive into Section 4, reading between the lines to see where management is placing their bets. So, moving past the raw financials, the most glaring change in the whole document is right here in research and development. Expensed R&D jumped from $1.2 million last year to $3.4 million this quarter. That is a massive 98% jump in total R&D spend. Management is not just tweaking the software here, they are aggressively pivoting. They explicitly mention building an integrated, cloud-enabled modeling ecosystem that connects their scientific engines with AI-driven capabilities. They are betting the house that AI is the future of virtual drug testing, and they are spending real cash today to make sure they get there first.
All right, Section 5, red flags. What could go wrong?
Look, no business is perfect, so let's talk about the specific risks hidden in this 10Q. The biggest immediate constraint is an impending corporate merger that's expected to close in Q4 of 2026. The filing notes that management is currently bound by interim operating covenants. In plain English, their hands are completely tied until this deal actually closes. They are restricted from buying back their own stock, paying dividends, or making any significant capital expenditures outside the ordinary course of business. They are essentially stuck in a holding pattern. There's also a secondary kind of minor red flag buried in the notes. They are holding non-FDIC insured cash in a French bank. Now, the filing states they haven't experienced any losses and they view the institution as totally stable, but it's a small, real geographical and counterparty risk worth noting, especially given the weirdness in today's banking environment.
Which brings us to Section 6, the bottom line.
So, what's the final verdict based strictly on this 10Q?
Simulations Plus is a classic impairment recovery turnaround. It's a highly sticky, cash-generating software and consulting business with some serious regulatory moats. They are currently tilting heavily toward an AI future. But operationally, they're in a bit of a holding pattern right now, just waiting for that major Q4 merger to close. If you're keeping tabs on this company, here are the 3 exact things to watch in their next filing. Number 1, does that Q4 merger actually close smoothly and lift those operating covenants? Number 2, does this massive jump in AI R&D spending actually start translating into higher software revenue? And number 3, can they maintain these great gross margins on the consulting side as they scale? Basically, will their massive bet on AI make them the undisputed king of digital drug trials? Or is this holding pattern a sign of deeper integration struggles ahead? That is your Edgar brief on Simulations Plus. Remember, this was a translation, not a recommendation. Read the original on sec.gov if anything caught your eye. Thanks for hanging out with us at the Edgar Brief. We'll see you in the next filing.